Welcome back, everyone. I have my co-hosts here, Crichton and Rimmer Bear. You may have seen Rimmer Bear before. So yeah, today I want to revisit the topic of point of control, because I've been getting some traders coming to me for performance coaching, trying to use point of control as a key level yet again. Now, last time I didn't throw out any stats, but I think it's time. All right, let's go. All right, let's begin. If you don't know what point of control is, it's a market profile concept, and it represents the widest. You know what? Actually, if you don't know what point of control is, then this video is probably going to go way over your head anyways. So if you're interested, maybe you should Google it first and then come back. And for the rest of us, there is a strategy called naked POC. It means the price going back to the previous day point of control that has not been touched yet. It's virginal. Now, that strategy does have merit. And before I hit you with some mind-blowing stats, make sure to like the video, subscribe to the channel, and switch on all notifications if you want to know all things futures, performance improvement the right way, and how to come up with solutions to your trading troubles. Okay, so let's have a look at the chart. This sample size is only about 6 months. So not the biggest sample size, around 120 days. And actually, if I take a longer sample size, it looks similar, but kind of slightly worse probability-wise. However, it is a fairly accurate representation of what you can expect. These are the three pretty widely traded instruments when it comes to futures and prop trading. In blue, I have ES, S&P futures. Then I have CL in red, crude oil. And then I have gold futures in green. The first column measures how many times the price opened away from yesterday's point of control, then went to touch POC. I excluded the days where the market opened very near POC, because then there's no opportunity. You have no space for any meaningful trade. So in the past 6 months, we had this event, price going back to previous day's POC, which, may I remind you, is a closed, fixed price, fixed level that we can quantify. I will say I didn't pair this up with a value acceptance or any kind of open sentiment. There were inside days that still had the price open away from POC, then go to POC first. So open sentiment was not a part of this analysis. I just wanted to make that perfectly clear. And if you can see here, this event is pretty consistent across all three products. And it happens roughly about 33% of the time in the previous 6 months. Okay, so 33% of the time, price went from the open, wherever it opened, straight to the previous day point of control. Now, a 33% frequency of occurrence is actually right up there with the trending days. That's roughly the same percentage that the market actually properly trends. I showed you that in one of the lectures in my free VWAP mini course right here on YouTube. I'm going to pop a link right here. One thing that I observed is that when the market touches point of control, it actually rarely stops at point of control. Now, this next column, it's like a subset of the first column. But this next column looks at how many days we had where the previous POC acted as a stopping point, as a key level, as a reversal area, which is something that I see people doing a lot. Nearly every person who's come to me for performance coaching with some knowledge of market profile, they're like, I'm going long of POC. So I'm like, why are you doing that? So to break it down, we have 33% of the time price opening away from POC and then going straight to POC. And then you have a subset of days that comprise, well, effectively 33% of the 33%, where the price indeed does stop and turn around. But if we look at the whole 6 months, you're looking at an occurrence of about 8%. So literally we've had 11, 12 days in these instruments where POC from the previous day acted as a stopping point. For the rest of them, it went straight through, did not look back. So I think you'll agree with me when I say that this is actually a pretty rare event. It's not a valid strategy. If someone came to you and said, hey, my algorithm only works properly 10% of the time, give me your money. what would you do? Run away! You need a strategy that is valid straight from the beginning, okay? That immediately has some sort of hit rate. And that's not 10% or less of the observable sample size. Now, the third column looks at another strategy. Now, this one is a little bit sketchy in my eyes because it uses a developing point of control as a key level. So developing point of control means current day point of control that keeps changing throughout the day with every 30-minute TPO. Personally, I don't like using levels that you cannot easily quantify and that change a million ways in a day. So what I've measured here is the developing POC prices that were created within the first 3 hours into the active trading session, okay? So if the price retested one of those as the developing point of control was recalculating, this test would still do a count. But again, look at the numbers. ES actually does a little bit better here with 12% of occurrence, but CL and GC are sitting at 9 and 10%. So look at this. If you wonder why I don't like people using developing POC for anything and why I don't use it, is because of this. Now, when it comes to using developing point of control as a target, because of the nature of the developing point of control, you will get multiple tests of it, especially if we have a ranging day. So you could use the developing POC as a target. That's a high probability event on most days, apart from trending days. But ranging days are actually pretty common. They happen more than half the amount of time. So even when I look at 3 to 6 years period, even longer, like I've looked at 10 years of how often the ranging days appear, and it's within sort of 54 to 57% of the time. And that stays pretty consistent whatever year you're looking at. So using point of control as a target definitely has merit. The rest of it, as useless as an inflatable dartboard. The importance of using right levels that happen fairly frequently is absolutely paramount to your success as a trader. Backtesting of this sort, equally important. Quantifying levels that you can actually test, also terribly important. Now, this sort of process will give you extra confidence. So when you sit down to trade, now you will be armed with some actual information about the levels that you're using because you sat down, shock horror, to test whether the strategy actually occurs on its own as a successful intraday event more than 10 days in a 6-month period. And if not, throw it away! That's it for now. In the meantime, let's strive to be less Muppet and more Mucker Stalker with every passing day. Goodbye!